Welcome. Today we're going to chat about some fixed income topics. In particular, the role that fixed income or bonds play in a portfolio allocation. A lot of our clients have been asking the question, what's the future of bonds in my portfolio? It is a hotly debated topic amongst our peers as to what will bonds serve in terms of portfolio diversification, in terms of return going forward. So let's just start talking bonds in general and maybe start with where fixed income, where bonds are today relative to other asset classes in terms of expensiveness.
Yeah, everything's expensive. You could say every financial asset right now is expensive or the most expensive it's been in history or near there. But high quality bonds are probably the most expensive among all the expensive asset classes. We've been saying since this crisis and since the Fed response that the only thing more expensive than stocks right now are high quality bonds and cash, which you get basically nothing. So when we talk about bonds being expensive, another way of saying that is interest rates, i.e., yields, are low. They are near or at all-time lows. So when bonds are expensive like this and yields are low, you have to question how much you as an investor are going to get in the future in terms of total returns from buying that bond today, given that low starting yield.
So maybe just set the stage for what type of return should I expect from a bond, and then maybe talk about the different kinds of bonds that would be in a portfolio.
Yeah, we can start and give the highest level example where we're just looking at the 10-year Treasury note, sort of the most common fixed income instrument in the world. There's zero credit risk, 10 years to maturity. The yield right now on the 10-year Treasury note is below 1%. It's somewhere around 95, 90 basis points as we shoot this video today. And so when you take that yield right now, that actually is a very good forward return estimate.
So let's throw this chart up and to illustrate the point you're making here on Treasury yields.
Low yields now equals low returns later. And what we're showing here, the dark blue line, is the yield or interest rate on the US 10-year Treasury note, all the way going back to the 60s. And you follow this all the way to the bottom right, and you can see when this chart was struck, the 10-year Treasury note was yielding 0.78%. And that starting yield is actually a very good expectation for what you would earn as an investor if you bought that bond today and held it to maturity. And we prove that out by overlaying the green line, which is at each point in time what total return the investor would have gotten had they bought and held that bond to maturity. This idea and this mathematical truth, if you will, is the basis of how we create all of our forward-looking return estimates, or forward-looking lack of return estimates, if you will, for bonds over future time periods.
Right, and so what's also embedded here is the idea of sort of pre-1980 that yields can go up, which would result in bond prices going down, which would mean the investor would potentially lose money holding on to bonds. So right as we sit here today, it's not an attractive alternative to buy a bond unless you believe, one, rates are going to go significantly lower, right?
Mm-hmm.
Or that they're going to perhaps gradually rise over a long extended period where you can sort of ladder into your allocation. Would that be a fair assumption?
Yeah, it's very fair. And if you think rates are going to rise, then definitely not an attractive investment. And so you think, from a return and an income perspective, it's not really attractive to buy bonds right now. So if you are owning bonds, which our clients do own bonds, it's for the capital preservation and it's for the diversification. It's something that hopefully will maintain its value if the rest of the asset classes in your portfolio go down in value. So stocks go down, hopefully these maintain their value. But yeah, all this is playing out to, if interest rates stay the same, you're not making any money. If they go up, you're losing money. And hopefully they go down, but how much further can they go? How much lower can they go? If your starting yield is 78 basis points, if you were to earn 3.94% total return over the next 10 years, So over the next 10 years, you recreate the total return that investors got from the prior 10 years. How much lower would interest rates or yields have to go in order for that to happen? And the answer is the 10-year Treasury yield would have to fall to negative 4.66% at the end of the 10-year period. And so we break this out in different colorful bars. You can see your income return becomes negative, your capital appreciation has to keep getting larger and larger. So interest rates have to fall more and more so you get more capital appreciation to get anywhere near that 3.94% target. So that's out of the cards. If
Right.
you're thinking, what am I going to get owning this bond over the next 10 years, and you take the return over the last 10 years, you're going to be wrong. You're going to be very wrong. It's almost a mathematical impossibility that you're right.
Right. And so let's extend the discussion beyond just a treasury bond. There's also what's called credit and different types of credit, and there's credit spreads. So just give us sort of an overview of what the credit bond market looks like and what potential returns we could get there.
Yeah, so interest rates, treasury yields, which we refer to as base rates, are near all-time lows. And then credit spreads are basically the tightest they've ever been in history. So they're very small. So you think about the yield you would get on, say, an investment-grade corporate bond. Say it's a 10-year investment-grade corporate bond. To look at that yield, you'd say, well, the first part of it is I'll get whatever the yield is on the 10-year treasury. And then I'm adding a little more credit risk. So I should get some additional yield. I should get compensated for lending to a corporation, which theoretically is riskier than lending to the government. But that additional yield I get for lending to a corporation is also the smallest additional yield you've ever gotten. So we'll focus in on the first set of bars on the left. And what this is showing, this is akin to the current yield on the bonds. So core bonds, you think that's sort of the bedrock of most fixed income allocations, something similar to the Barclays Ag Bond Index. The current yield is 1.2%. And that's nominal. So yeah, it's more than you're getting if you just lent money to the Treasury or to the government, but it's not that much additional compensation. And then you think, well, inflation has been running 1.5 to 2%. So after inflation, I'm probably losing money. And then you start to move out on the risk spectrum. So then you think, well, I'll just lend to investment grade corporations. And that's the next bar to the right. Current yield there is 1.8%, still not very attractive. And then the sort of the riskiest area, the most credit risk of the fixed income area, you would say high yield bonds. So below investment grade companies, there you get 4.7%.
So those look decent, right?
Yeah, those look reasonable, but those are also the lowest yields in history. So they still not, I mean, typically, and you think coming out of the global financial crisis, you were getting a 20% yield to buy high yield bonds at the depth of the global financial crisis. And here we are coming out of the COVID-19 crisis, and you're getting 4.7%, which actually doesn't even look that attractive compared to, say, the dividend yield you can get on some high quality stocks.
From a high level, the investment landscape, people are searching for yield, and without the ability to buy treasury bonds or investment grade corporate bonds, we're pushing more buyers into these other asset classes, which should theoretically support the prices going forward and avoid the types of defaults we've seen in the past. Maybe talk through that for the viewers.
Yeah, when you talk about the riskiness of an asset class, and basically what you're saying is money will flow into and out of that asset class significantly and abruptly without warning. That is a risky asset class. So if you take an asset class that historically has been risky, like high yield bonds, those were down 20 to 40% as a basket during the global financial crisis. And you think, what if money just flows into this asset class continually? It's a constant flow into the asset class. Well, then that takes away all the risk. It doesn't feel like high yield bonds of '08 because the flows into this asset class are muting the risk. So the risk never really reveals itself, if you will. You think there are a number of high yield companies that are on the brink of default, but were able to skirt default or do another bond issuance because the money flowing into this asset class was so significant. So that solves sort of all the problems, if you will, the continual flow of money. And you think, where is this money coming from? And we've talked about money supply growth in the US is at all-time record highs. And we can look, as US investors, we can look at these yields and say, these are not very impressive. But I mean, if you're overseas, these are extremely attractive yields, extremely attractive. The Portuguese 10-year, Portugal, which was on the brink of default not too long ago, 10-year Portuguese bond is now at 0%. Same thing in Greece. We just a few years ago, we're talking about Greek sovereign debt crisis and IMF bailouts. Their 5-year bond is yielding 0.
Right.
So you think about there's so much money being created, and it's all flowing into these asset classes that historically were risky. And if the flows continue, these asset classes are just going to feel less risky than they have been in the past.
Right. Yeah. So let's sort of translate that into how to think about portfolio allocation. So we'll dip briefly into this and we'll do a much more in-depth look at this later. But the next slide, looking at allocations and sort of we're showing here today how to get 6% because that's a number people generally target 6 to 8% returns. Take us through what it looked like 15 years ago and what it looks like today.
Yeah, 15 years ago, if you wanted to get a 6% return, you could invest in a relatively conservative asset mix. So we're showing here 61% of your portfolio in core bonds, because the yield you were getting on a core bond allocation 15 years ago was plus 4%. You were almost getting your entire return target from the safest asset class in this portfolio. So you didn't need to dabble much in equities, which we know historically have been more volatile. But you fast forward to today with interest rates near all-time lows and credit spreads near all-time lows or all-time tightness, it's actually flipped. So you would only be able to allocate about 37%, we'll call it 40% for round numbers, into high quality bonds. And the rest you're going to have to take on more risk to get to that return target. So you're going to have to invest more heavily in equities. And what you get is a similar expected return, but obviously greater expected volatility. Equities are more volatile than bonds, certainly.
Throw up the next chart and look at that actually while you're talking.
Yeah, so a bumpier ride to the same place. So what we've done here to prove that out is we've taken 1-year rolling returns since 1926 for each of these two portfolios we just showed. And you'll see a similar average return. So the dark blue line in the middle of these bars, 8-9%. Going forward, we think lower, probably closer to 6%. But what you'll see is a much wider range of returns for the heavier stock portfolio, the bar on the right. So there, your fifth percentile outcome over a 1-year period was you'd lose 11% of your assets in that portfolio, whereas your fifth percentile outcome in the more conservative portfolio you could have owned 15 years ago is only a negative 4% return. So just a bumpier ride to the same place.
How do you think about your equity allocation if more investors are being forced into buying equities globally? Do we have that same type of safety net if you're buying equities? Do equities become less volatile going forward?
Well, you think naturally they should. So if you think about the scenario once again where there's so much money being created and it's flowing into the safest asset classes first, things like treasury bills, treasury bonds, and then out into even corporate bonds. You think about the transactions that the Fed is engaging in currently. What it's going to do is force investors who were previously in those safe asset classes into these asset classes that historically were riskier. And those riskier asset classes they're moving into are now going to have flow characteristics that are actually much more similar to high quality bonds. If you think about now, maybe over the next 10 years, the bedrock of my portfolio goes from core bonds to high quality dividend paying stocks, because I used to get income out of core bonds and now I don't. That could be how portfolios shift. over the next 10, 20 years if this very low interest rate environment and money creation by central banks and governments continues, which we think in all likelihood it will.
And there's obviously other alternative asset classes that we use in our management of our client assets, like covered calls, other ways to generate income. And I think we're starting to see different types of products being developed to provide income as we go forward. Is that a fair statement?
Yeah, definitely. To provide income, but basically think about the things bonds used to provide. It wasn't just income, but it was return potential, and it was also diversification and capital preservation. And so if you can't get those things out of bonds, there are new asset classes and strategies being created, or they existed but are now becoming more popular, because maybe these asset classes can't do all the things bonds used to do, but they can do one of them very well. You think about buying volatility is a strategy that is starting to get some very strong flows into the asset class. Because you think if my stock portfolio goes down 20, 30%, interest rates can't fall enough for me to make up those losses on the side of my bond portfolio. So what can I own that I know is going to go up in value during those big market drawdowns? Something like owning volatility.
So Mike, this has been a great sort of starting point on the discussion of asset allocation, and specifically fixed income and the role. And we didn't even get into the role of cash in a portfolio going forward. But I guess as part one, give me a preview of what part two might look like here in our discussion.
So a big part of this discussion is, what happens over the next 10 years if interest rates do rise? And how does that relate to the amount of debt that the country has taken on and the Treasury is going to be issuing? So looking at historical analogs there. And then if you don't think interest rates are going to rise, nominal rates, but you think inflation is going to be there, how can you protect your bond portfolio and the rest of your portfolio in that type of an environment? So these are all various strategy elements that we're going to be discussing.
Awesome. Well, look forward to that discussion. And until next time, have a great day.